there, my name's Nick, and thank you for tuning in for the weekend edition of the Market Recap. This is a new segment that I'm going to start introducing on a weekly basis to highlight some of the key events that have happened over the past week. Something that maybe you would miss in the news, or just kind of basically summing everything up and giving my take on what's going to happen in the market. On today's edition, what we're going to be taking a look at is S&P's performance past 30 days, past 7 days. We're going to be taking a look at the VIX and how that works in the inverse relationship with the S&P. We're also going to be taking a look at the fiscal and the monetary policy that's taking place. I know the Fed has already made moves, and I know we're still waiting for the Senate to agree, and we'll touch on that a little bit later. We'll also look at some unemployment numbers which were released. This gives us our first true glimpse of what's going on right now. And to top it off, I'm going to kind of give a worst case scenario where I think the S&P is going. And hopefully it doesn't get there, but just to know, hopefully mathematically, where the bottom is. So with that being said, let's get right into it. I think the first thing to take a look at is just bird's eye view, a 30-day history of the S&P 500, which obviously is the main index fund in which a lot of financial advisors peg their returns to. And if you take a look at it, what we can see is a 30% decline from market highs, and it's probably one of the quickest market pullbacks that we've ever seen in history. These are unprecedented times. Nothing, no SARS, no Ebola has affected the market to this degree. This is definitely a black swan, as some people refer to it as. Getting a little bit more specific, we can take a look at the 7-day chart, and from there we could see that we had a 7% decline this week in the S&P 500. We're seeing levels around 2,300. I know there was a few times throughout the week where it did try and hold that 2,400 mark. It's one of those key technical indicators, pulling back basically to December 2018, kind of around that 2,400 mark. So that's kind of where we're at today, and we'll definitely touch on it a little bit later in the video, but some unfortunate news coming out that we're looking at a limit down for the S&P come Monday, March the 23rd. What I want to highlight to you next is the relationship between the VIX and the S&P 500. So the VIX is a market index that measures implied volatility. What that means is when that number's high, the market is shaky. It is up, it is down. There will be a calculation later that we can look at that you can kind of get an indication of where that market's going on a percentage basis. And but first, what I'd like to do is just show you an example from the Great Recession in 2008 through to 2013 and the inverse relationship between. So when we take a look at this chart, the orange figure is the orange line on the graph is the VIX, and the gray is the S&P 500. What you can notice is the VIX spikes in October 2008 when the problems started happening, and you can relate that now back to what's happening today. You can see that as we move closer to January 09, when in between January 09 and April 09, when the market bottomed, the VIX does start coming down. So don't use the VIX as a market indicator as a bottom. I think right now, if we're taking a look at today's current situation, I think that we have a little bit further to go, but that's my own personal opinion. Just wanted to highlight here, traditionally as the VIX does go up, the S&P does follow in an inverse or opposite pattern. It goes down. and just wanted to provide some information so that you can use that in your analysis today. The calculation that I was referring to before will help determine the percentage that is implied that the market will move. Now, like I mentioned before, it could be higher, it could be lower, but using 65 as the example, we divide that number by the square root of 12, and that number I use is 3.46. So at these measures, I have the market moving still 19% implied from this point. So I don't know if that's 19% to the upside or 19% down to the downside, but it's just an indication that there is so much volatility that it's not the right point for me to start making any entry positions on a S&P index fund or anything. Just one more thing on the VIX. Here's a quick comparison from 08 to 2020. The difference in the VIX, you can see that there is a huge discrepancy. Just to give you what I believe is to be a little bit more of a severe situation that we're dealing with right now. We do need to have a lot of eyes on, and basically everybody's attention on helping the economy get back to its once high levels. On to topic number 2, we're going to talk about the government help. We're going to talk about monetary policy. We're going to talk about fiscal policy. We've seen the Fed come out so far, that's on the monetary side of things. They've cut their rate by 1.5 points. This basically lowers the cost of borrowing, mortgages, loans, car, auto loans, etc., home equity lines. From there, what I basically like to point out is that rate is zero. It hasn't been this low ever, to my understanding, and the only way further down is negative, and that is uncharted territory. We've also seen them lower the rates for the charges on bank loans, basically lower than the rates that we've seen in the Great Recession. Quantitative easing is in place. The Fed pledged to buy $500 billion in treasuries and $200 billion in mortgage-backed securities. Primary purpose of this is to restore smooth market functions so that credit can continue to flow. We've also seen a term that was new to me but introduced by Milton Friedman, and that is helicopter money. So it basically probably only like a month or so ago, we had Andrew Yang, who was running for the Democratic Party leader, and he brought to our attention the Yang economics, or the freedom dividend, where he was going to give every citizen, I believe working age citizen, $1,000, just to make it easy for them. It's referred to as helicopter money, basically injecting a large sum of money. This is now more on the fiscal policy side of things. This has now been adopted by the Republican Party, and they're trying to get this passed in Senate. As of today, they've rejected the first portion. The Democrats and the Republicans did not agree to the first bill. We've seen that reflected in the markets. The markets are limit down to open trading on Monday, the 23rd. So it'd be interesting to see how quickly they can act. As I mentioned before, this is unprecedented times. We need quick action. What we're going to be talking about next is unemployment. We've had some numbers come through that are relatively shocking. I know we had predicted a slight decrease, but the percentage change is so vast that it is larger than any number we've seen before. The numbers came in and they're about 33% increase in unemployment rate. The number, I believe, went from 200 to 280,000. The largest percentage increase during the Great Recession week over week was 14%. So just to give you an idea of how vast that is, unemployment rate in the US was about 3.5% in February. Economists are projecting that number to be 6.5%. So that number is going to double, and that is by June. So in the summertime, halfway through the year, the unemployment rate is going to double. These numbers are something that are unfortunately inevitable. Hopefully the fiscal policy that's in place basically helps restore small businesses to keep those employees on board, give them some type of payment rather than have them claim unemployment insurance and go from there. So that's something that we'll definitely be keeping an eye on, and it gives us an indication of where the current economic stance is, just in terms of that employment figure that was so highly touted in years past. Now, to finish it all off, what I'd like to do is just break down some of the reasoning, how I'm going to get to this number. And first and foremost, it's the prediction of what the worst case scenario of the S&P 500 looks like. So if we take a look at using the Great Recession's numbers of how the price to earnings multiple fell and future earnings, what they were trading at, and what the current earnings per share was of the company, we can find an approximate area where the level of the S&P might come down to, and that's obviously on a worst case scenario. Not saying that it will get down to that point, but it's definitely a potential. So currently on the S&P, companies are earning about $150 a share. So from there, what we can find is in 08-09, we saw earnings per share fall 40%. So easy math, that takes us down to $90 a share earnings. So if we project that this current drawdown is going to be anywhere similar to the Great Recession, then that $90 a share is what we're going to stick at. From there, fair value for future earnings is probably around 16. So what I'd like to do there is I take the earnings per share and I multiply that by the fair future value, 16, and you get about 1440. Okay, that is the number that I am considering for my worst case scenario. I think that if we do continue to see the negative numbers on employment, the uncertainty of when we can return to work and get the economy up and running, basically the medical protocols of how we're dealing with the current scenario, whether that is social distancing or whatever, there's just too many uncertainties for me to give you a little bit more of an accurate prediction. But I think that number, that 1440, is worst case scenario. So how again I got to that, I reduced 40% of the retained earnings from current valuation, and the 16 multiple is fair value. Multiply those two together and I'm at 1440. Now we're about 2300 right now, so it'd definitely be huge if we got to that number. Hopefully the global community can come together and help us get out of that. But yeah, that's just basically the current situation, and unprecedented times. We will learn from this. The market will one day hit all-time new highs. It's just basically market cycles. Well, I hope you enjoyed this video where we highlighted a few events that have happened over the past week, added some insight. If you like it, subscribe down below. I'd appreciate that. Please like it and share it if you enjoyed it. Thanks a bunch, and we'll see you next week.